Have you ever thought about what it really means to own something in America? It seems simple, right? You buy a house, you own it. You buy a stock, you own a piece of a company. But what if I told you that ownership and control are two very different things? This is one of the biggest, most misunderstood concepts in our economy. And today, we're going to break it down. Let's start with the stock market. Say you buy a share of Apple. Congratulations. You are now a part owner of one of the world's largest companies. You have a legal claim to a tiny fraction of its assets and profits. So, can you walk into Apple headquarters and tell Tim Cook how to design the next iPhone? Not a chance. Why? Because you have ownership, but you don't have control. In the corporate world, control isn't about how many individual owners there are. It's about who holds the most voting power. Major decisions in a company are made by the board of directors, who are elected by shareholders. But not all shares are created equal. Some companies have different classes of stock. Class A shares might get 1 vote per share, while Class B shares, often held by founders and insiders, might get 10 votes per share. This structure lets founders like Mark Zuckerberg at Meta maintain control, even if they sell off a majority of the company asset. So, while millions of people might own shares, the actual control is concentrated in the hands of a very small group of people aboard major institutional investors like BlackRock or Vanguard, and founders with supervoting shares. These institutions manage trillions of dollars in assets on behalf of millions of individual investors like you and me. They are the ones who vote on board members, approve executive pay, and weigh in on major corporate strategies. As an individual retail investor, your single vote is like a drop in the ocean. You own a piece of the pie, but you have almost zero say in how the pie is made or sliced. Now, let's switch gears to real estate, which feels much more tangible. You buy a house, you get the deed. The keys are in your hand. This is your castle, right? You own it and you control it. Well, mostly. Your control is actually limited by a bunch of external forces. First, if you have a mortgage, the bank technically holds a lien on your property. You have the title, but if you stop making payments, the bank can foreclose and take the house. They have ultimate financial control until that loan is paid off. Your ownership is conditional. Second, think about property taxes. You have to pay them every year, whether you have a mortgage or not. If you fail to pay, the government can seize your property and sell it. So, are you truly the absolute owner if someone else can take it away for non-payment of a recurring fee? Then there's the government's power of eminent domain. This is a legal principle that allows the government to take private property for public use, like building a highway or a school, as long as they provide just compensation. Your personal desire to keep your home doesn't matter if the government decides it needs your land for a public project. And don't forget about zoning laws and homeowner associations, or zoning laws dictated by your city or county tell you what you can and KUHN do with your property. You might want to build a second story or run a small business from your garage. But if zoning laws forbid it, you're out of luck. HOAs can be even more restrictive. They can dictate the color you paint your house, the type of fence you can build, and even where you can park your car. If you violate their rules, they can fine you and, in extreme cases, even place a lien on your home. So, whether it's stocks or real estate, the American dream of ownership is more complex than it appears. Ownership gives you a financial stake, a claim to value, but control, the power to make decisions and direct how an asset is used, is often held by others. It's held by corporate boards, institutional investors, banks, and government bodies. Understanding this distinction is crucial. It helps us see the economy more clearly and make smarter financial decisions. When you invest, you're not just buying an asset, you're buying into a system of rules and power structures. Recognizing where the real control lies is the first step to navigating that system successfully. Thanks for watching. If this video opened your eyes, hit that like button and subscribe for more content that breaks down the world of money and power. See you in the next one. At first glance, it looks like more people than ever are participating in the financial system. Millions of Americans contribute to 401ks, pensions, IRAs, and brokerage accounts. They own pieces of the stock market, pieces of corporations, pieces of the economy. This creates a powerful narrative that the middle class is deeply invested and therefore empowered. But this is where the illusion begins. Most middle-class investors don't own stocks directly. They own funds that own stocks. The distinction sounds small, but it changes everything. When money flows into a retirement account, it usually ends up in index funds or target date funds. These are designed to be simple, diversified, and passive. You set it, forget it, and let the system run in the background. The trade-off of that simplicity is influence. The average investor has no idea which companies they actually own, how much voting power those shares carry, or how that power is exercised. They don't receive ballots asking how a company should be run. They don't weigh in on executive compensation or long-term strategy. All of that is handled automatically by fund managers, whose names most investors never learn. This creates the feeling of ownership without the substance of it. Your account balance moves, your statements arrive, and you feel involved. But your role is limited to contributing money and absorbing risk. Decision-making happens somewhere else, by someone else, according to priorities you didn't set. Even when people do vote with their dollars, the impact is that pulling money out of a fund doesn't send a message to a specific company. It just shifts assets between managers. The underlying system remains unchanged. This is very different from direct ownership, where a decision to buy or sell directly affects a business and carries clear intent. Another part of the illusion is scale. A single middle-class investor might own a few hundred or a few $1,000s worth of stock in a company. That sounds meaningful until you compare it to institutions that own billions. When votes are counted, influence isn't democratic. It's proportional. One share, one vote. The result is predictable. The system reinforces passivity. Retirement plans are structured to discourage engagement. Choices are limited. Language is complex. Time horizons are long. People are taught that the best move is to stay quiet, stay invested, and trust the process. Over time, this trains investors to believe that involvement is unnecessary or even harmful. Meanwhile, the concentration of ownership grows. As more people choose the same few low-cost funds, those funds accumulate larger and larger stakes in the same companies. The middle class becomes more exposed to the market but less influential within it. Participation increases. Power does not. This gap is rarely discussed because the system still works well enough on the surface. Markets grow, accounts compound, people retire. But beneath that stability is a disconnect between who supplies the capital and who directs it. The middle class funds the economy, but it does not steer it. What makes the illusion so convincing is that it isn't entirely false. Middle-class investors do benefit from growth. They do share in profits. They do have a stake. But ownership without agency is a limited form of ownership. It gives you exposure, not authority. Over time, this shapes how people see their role. Investing becomes something that happens to them, not something they actively participate in. Wealth feels abstract. Control feels distant. And the idea that widespread ownership equals widespread power quietly fades into the background, unnoticed by the very people it affects most. When people think about power in the financial system, they often picture banks, hedge funds, or wealthy individuals. What rarely comes to mind are asset managers. These firms don't usually make headlines, don't take flashy risks, and don't present themselves as power brokers. Yet they sit at the center of modern ownership, quietly accumulating influence through scale rather than speculation. Asset managers operate by pooling money from millions of investors and deploying it across markets. Index funds, ETFs, pension funds, and retirement accounts all flow through a relatively small number of firms. Individually, each investor is insignificant. Collectively, their capital becomes enormous. The firm managing that capital becomes a gatekeeper. Over time, this leads to a remarkable outcome. A handful of asset managers end up owning large percentages of major public companies. Not as founders, not as entrepreneurs, but as stewards of other people's money. Across entire sectors, the same firms appear again and again among the top shareholders. Airlines, banks, tech companies, energy firms, consumer brands, all linked by overlapping ownership. This creates influence without visibility. These firms don't need to issue commands or make public statements to shape behavior. Their presence alone matters. Corporate executives know who their largest shareholders are. They know whose votes decide board seats, mergers, and executive compensation. When a small group consistently holds that power, companies adapt accordingly. What makes this dynamic unusual is that asset managers are not supposed to be active. They are framed as neutral intermediaries, simply tracking markets and acting in the best interest of clients. But neutrality at scale is still power. When you vote on behalf of millions, even standardized decisions carry massive weight. This concentration also changes competition. When the same asset managers are significant shareholders in multiple competing companies, incentives shift. The goal becomes stability and broad market performance rather than aggressive competition between individual firms. That doesn't require coordination or conspiracy. It's a structural outcome of diversified ownership. The rise of passive investing accelerated this process. As investors chased low fees and simplicity, money flowed into the largest funds. Those funds grew larger, gained more influence, and became even more attractive due to their size. Smaller firms struggled to compete. Capital consolidated not because of intent, but because of efficiency. Unlike traditional owners, asset managers rarely appear accountable to the public. Their decision-making processes are complex, internal, and difficult to observe. Proxy votes are cast quietly. Policies are written in technical language. Most investors never see how their shares are used or why certain decisions are made on their behalf. This creates a strange imbalance. Asset managers hold enormous sway over the direction of corporate America, yet they operate largely outside public debate. They don't run for office. They don't face voters. Their power grows through market participation, not political mandate. At the same time, their incentives are layered. They answer to clients, regulators, and markets. But those pressures don't always align with long-term societal outcomes. Decisions that maximize efficiency or reduce risk for a fund may still reshape industries, labor practices, and innovation paths in profound ways. The most important shift is psychological. Power no longer looks like ownership in the traditional sense. It doesn't come from founding companies or building factories. It comes from managing flows of capital at scale. Influence is exercised through spreadsheets, voting guidelines, and portfolio weightings rather than direct commands. This is why the rise of asset managers represents a fundamental change in how America is owned. Control has moved away from visible figures and toward institutions designed to appear invisible. The system feels decentralized because participation is broad, but the levers are increasingly held by a very small group that most people never think about at all. Most people believe that owning assets is the ultimate form of power. Houses, stocks, businesses, land. But in the modern financial system, debt often matters more than ownership. The ability to issue debt, price it, restructure it, and enforce it creates a level of influence that asset ownership alone cannot match. Debt shapes behavior before any asset changes hands. Governments adjust policies to satisfy bond markets. Corporations prioritize cash flow to service liabilities. Individuals choose careers, delay life decisions, and accept risk based on repayment obligations. In each case, the presence of debt quietly dictates outcomes. At the highest level, the US government is one of the largest debt issuers in the world. Treasury bonds underpin the global financial system. Institutions that buy, sell, and trade this debt influence interest rates, currency, strength, and liquidity, while voters may choose leaders. Markets effectively set the boundaries of what policies are financially acceptable. When borrowing costs rise, options narrow. Corporations operate under the same logic. A company with little debt has flexibility. A company loaded with debt answers first creditors. Expansion plans, hiring decisions, research budgets, and even survival depend on meeting debt obligations. In restructurings and bankruptcies, shareholders are often wiped out while creditors retain leverage. Ownership ranks below debt in the power hierarchy. This flips the traditional narrative. The people who own companies are not always the ones in control when conditions tighten. Those who are owed money often have the final say. Covenants, repayment schedules, and refinancing terms become tools of influence, shaping strategy without ever appearing on a shareholder vote. Consumers feel this most directly. Mortgages, student loans, auto loans, credit cards. These debts don't just finance purchases. They structure lives. Debt determines where people live, what jobs they can take, how much risk they can afford, and how dependent they are on steady income. In aggregate, this creates a workforce optimized for stability rather than leverage. Financial institutions sit at the center of this structure. Banks, lenders, and credit markets decide who qualifies for capital and at what cost. Access to cheap debt accelerates growth. Expensive or restricted credit slows it down. Entire industries rise or fall based on financing conditions, not just demand or innovation. Debt also concentrates power during crises. When markets break, those with liquidity step in. Assets are sold under pressure, often at discounted prices. Debt holders convert claims into ownership or restructure terms in their favor. Each cycle reinforces the position of those who control capital access, while weakening those forced to borrow. Unlike assets, debt is proactive. It doesn't wait for appreciation. It demands payment on schedule. That urgency gives it authority. Miss a payment, and consequences follow immediately. This is why debt holders can exert control, even without wanting ownership. The threat of enforcement is enough. The system normalizes this imbalance by framing debt as neutral or necessary. Borrowing is portrayed as opportunity. Leverage is marketed as efficiency. While this can be true, it also masks how power accumulates upward through interest, fees, and enforcement rights. Small margins at scale become massive influence. Over time, debt transforms from a financial tool into a governance mechanism. It disciplines governments, constrains corporations, and conditions individuals. Decisions appear voluntary, but they are often responses to obligations already locked in. This is why control in America cannot be understood by looking only at who owns what. The deeper structure is who owes whom, under what terms, and with what consequences. Assets may represent wealth, but debt defines the rules under which that wealth can be used. For most people, the financial system feels like something distant and fixed. You work, you save, you invest, and you hope that over time, things move in your favor. But once you understand who actually holds control, the way you interact with money starts to change. Not emotionally, but strategically. The first shift is awareness. If ownership alone doesn't equal power, then simply participating isn't enough. Many people assume that because they invest regularly and stay in the market, they are aligned with how the system works. In reality, they are exposed to outcomes they don't influence. That doesn't mean the system is broken, but it does mean you need to be intentional about where you place trust. This understanding reframes risk. Market volatility is visible, but structural risk is hidden. Decisions made far above the individual level can reshape entire sectors, retirement outcomes, and job stability. When power is centralized, changes can happen quickly and ripple outward. Knowing this encourages diversification not just across assets, but across income sources, skills, and time horizons. It also changes how you think about debt. If debt is a primary lever of control, minimizing unnecessary obligations becomes a form of financial defense. Lower debt increases flexibility. Flexibility creates options are a quiet form of power in a system built on obligations and leverage. This doesn't mean avoiding debt entirely, but understanding its role beyond interest rates. Investing itself takes on a different tone. Instead of chasing trends or narratives, the focus shifts to resilience. Assets that produce cash flow, maintain purchasing power, or reduce dependence on external systems become more valuable. Liquidity matters. So does the ability to adapt when conditions change rather than needing to exit at the worst possible moment. Another implication is how you evaluate financial advice. Much of what's promoted assumes passive participation is the only realistic path. While passivity works mathematically, it also reinforces concentration. Being informed doesn't require active trading, but it does require understanding who is acting on your behalf and what incentives they operate under. This perspective also affects expectations. The system isn't designed to optimize outcomes for individuals. It's designed for scale, efficiency, and stability at the institutional level. Once you accept that, frustration gives way to realism. You stop expecting fairness and start planning around structure. Long-term thinking becomes less about prediction and more about positioning. You can't control macro forces, but you can reduce fragility. You can build buffers. You can prioritize learning over leverage. You can treat financial independence not as a number, but as reduced exposure to forces you don't control. Even small decisions take on new meaning. Emergency funds are no longer boring. They're leverage. Skills that generate income outside traditional employment are no longer hobbies. They're optionality. Understanding how systems work doesn't guarantee success, but it lowers the chance of being blindsided. What ultimately changes is posture. Instead of assuming the system will take care of you if you follow the rules, you recognize that the rules were written for scale, not individuals. That doesn't make participation pointless. It makes awareness essential. The goal isn't to fight the system or opt out entirely. It's to navigate it with eyes open, to align your financial choices with how power actually flows, not how it's marketed. Because once you see the structure clearly, every decision becomes less reactive and more deliberate. When you step back and connect all of this, a clear pattern emerges. Ownership in America is broad, but control is narrow. Millions participate, but only a few decide. Not because of a secret plan, but because scale, efficiency, and structure naturally concentrate power. Understanding this isn't meant to discourage you. It's meant to ground you. The system isn't personal, and it isn't designed around individual outcomes. It's built to function at massive scale, and that reality shapes who holds influence, who absorbs risk, and who adapts when conditions change. Once you see the difference between owning assets and controlling outcomes, you stop confusing participation with power. You stop assuming that following the default path guarantees security. And you start thinking more deliberately about flexibility, resilience, and optionality in your own life. You don't need to outsmart institutions. You don't need to predict every move. What matters is understanding the environment you're operating in, reducing unnecessary exposure, and making choices that give you room to adjust when the system shifts. Because the real advantage isn't knowing everything, it's knowing enough to stop being surprised. Hey everyone, and welcome back to the channel. Today, we're going to demystify something that affects every single one of us, every single day. The financial system. It sounds complicated, right? Like something only bankers and economists in fancy suits should worry about. But, trust me, by the end of this video, you'll see it's actually a system built on some pretty simple ideas, and understanding it can seriously empower your financial life. So, what is this giant, mysterious financial system? At its core, it's just a massive network that connects people who have money. We'll call them savers or lenders, with people who need money, the borrowers or spenders. Think of it as the world's biggest matchmaking service. But for cash, this network is made up of a bunch of different players, like banks, stock markets, and investment funds, all working together to keep money moving. Let's start with the most familiar player. Banks. When you deposit your paycheck into your bank account, you're not just storing it in a digital vault, you're actually lending that money to the bank. The bank then takes your money, bundles it with deposits from thousands of other people, and lends it out to someone else who wants to buy a house, start a business, or pay for college. In return for using your money, the bank pays you a small amount of interest. And for the risk they take in lending it out, they charge the borrower a higher interest rate. That difference is how banks make a profit. So, banks are essentially the middlemen, or intermediaries, that help channel money from savers to borrowers. But what if a big company needs to raise millions, or even billions, of dollars to build a new factory or develop a new product? Going to a bank for a loan that huge might be tricky. This is where financial markets come in. The two big ones you've probably heard of are the stock market and the bond market. When a company sells stocks, it's selling tiny pieces of ownership in itself. If you buy a share of a company, you become a part owner, a shareholder. You're betting on the company's future success. If the company does well and its value goes up, the price of your stock goes up too, and you can sell it for a profit. This is a great way for companies to raise a lot of money without having to pay it back like a loan. Now, let's talk about bonds. When a company or even a government issues a bond, it's essentially taking out a loan from the public. If you buy a bond, you are lending your money to that entity. In return, they promise to pay you back the full amount on a specific date. And along the way, they pay you regular interest payments, kind of like the interest a bank pays you. Bonds are generally considered safer than stocks because you're a lender, not an owner. So you have a higher claim on the company's assets if things go wrong. So we have banks, stocks, and bonds. All these parts work together, creating a flow of capital that fuels economic growth. Savers get a return on their money. Businesses get the funding they need to grow and innovate, and individuals can get loans for major life purchases. Of course, to make sure this whole system doesn't just go wild, we have regulators. In the United States, for example, you have agencies like the Securities and Exchange Commission, or SEC, and the Federal Reserve, often just called the Fed. The SEC makes sure that financial markets are fair and transparent, protecting investors from fraud. The Fed acts as the nation's central bank. It manages the money supply and sets key interest rates to keep the economy stable, aiming for low inflation and maximum employment. They are the referees of the financial world, making sure everyone plays by the rules. And that's the financial system in a nutshell. It's a dynamic network of savers, borrowers, banks, markets, and regulators, all working to channel money where it's needed most. It's what allows ideas to become businesses, families to buy homes, and economies to grow. It might seem complex from the outside, but when you break it down, it's all about connecting those who have with those who need. I hope this helped clear things up a bit. Understanding this system is the first step toward making smarter decisions with your own money. If you found this video helpful, please give it a thumbs up and hit that subscribe button for more content that makes finance simple. Thanks for watching, and I'll see you in the next one.